Well, Bank of America just released their 6 scenarios for what's going to happen with this economy. And unfortunately, Bank of America starts with, we remain concerned that markets are too optimistic on what it will take to bring inflation down. Not great. In this video, we're going to discuss the 6 different scenarios Bank of America believes could play out when it comes to recession or not. So the first scenario is the no landing scenario. They believe this is likely to be unsustainable. They indicate that headline inflation has come down, and while the economy has been resilient and the labor market has been stretched, which would be even better than the consensus estimate that basically the economy just keeps going, that we just don't land the plane, so to speak. It's just the economy just keeps going. Everybody continues spending money and everything's fine. And it's even more optimistic than the soft landing, is what Bank of America argues here. It's consistent with the argument that inflation was transitory after falling on its own. And unfortunately, as much as this would be fantastic, that the economy keeps going, inflation goes away, and we don't go into a recession, Bank of America believes that this is not sustainable. They essentially argue that the easy part of disinflation is over. And instead, now we have to deal with that sticky core inflation. That's going to keep pressure on from the Fed and basically makes the no landing scenario, in their opinion, unsustainable. Now, it's all a matter of time in their view, they argue. They say market pricing of rate cuts by early next year would actually be wrong in a no landing scenario. The longer it takes to land, the longer rates are higher. So in other words, the longer we have this strong economy and strong reports, the more the Fed says, all right, I guess we don't have to cut anytime soon. Now, that is interesting because they do argue in this that services inflation has been sticky, but then in the same segment, they also say, quote, however, services have now started to weaken, and they use that to argue that GDP is slowing down. Well, that would then also imply that potentially core services inflation would go down, right? Well, yes. B of A probably didn't tie those two together, but this is the scenario that Bank of America says is not likely, but could potentially be seen as the best scenario. Because again, it's better than the soft landing, the economy just keeps firing, and inflation goes away slowly. Soft landing is the consensus estimate of Wall Street. And this is the idea that the soft landing is about 6 months away, although frankly the soft landing has been deemed to be 6 months away for like the last 18 months. And the idea is that in a soft landing scenario, inflation comes down without needing to destroy the economy substantially, and without needing to raise interest rates any further. Data so far has unfortunately, though, been consistent with a no landing scenario. That's not sustainable, not with a soft landing. In other words, we're getting stronger sales reports, stronger GDP reports, stronger labor reports than would be consistent with some form of soft landing. So this is your consensus estimate right now. Now, what's next? Well, now you get Bank of America's baseline estimate. And then we'll get into some of the worst scenarios as well. I just want to point out here, Joel just wrote a comment. I just bought my 5th course last night, renovation and property management. Love it. Had to pause to catch up on the live stream. Thanks, Kevin. Thanks, man, for saying that. That's awesome. Yeah, check it out. Meetkevin.com or click the link down below for those amazing programs on building your wealth. You can email us with questions at staff@meetkevin.com or bundle up at the website. Get some really great products, still always trying to introduce new lectures and value for the existing members. We really love it. And it's free when we add extra content for everyone, of course. So what do we have with the hard landing, which is the Bank of America scenario? So with the Bank of America scenario, quote, we've consistently been expecting to take about 6 months to a year longer than the consensus for central banks to bring inflation down to target and start cutting rates. In other words, this is your over-tightened scenario, where basically to get core inflation down, they need to keep rates higher for longer, and that ends up crushing employment, and you end up getting negative payroll reads, and you end up in a substantially worse economy than where we are now. In other words, they don't expect inflation to come down. It's going to keep being sticky, and that is going to force a hard landing style recession where you do get that unemployment rate popping up a percent. And then historically, once you pop up a percent, you're going to pop up another percent. So all of a sudden, we go to 5.5 to 6% unemployment, which honestly is still not that bad compared to the 8, 9, 10, 11% unemployment we had during the Great Recession or during other recessions, not considering COVID. All right. Then you have hard landing scenario number 2. So hard landing scenario number 1 is just an unemployment recession. Hard landing number 2, which is scenario number 4 here, is something's going to break. That would not be great. There's an increasing risk that something may break. So far, nothing has broken. However, something can still break. As argued recently, the interest rate needs to be high enough to bring inflation to target. It's going to take longer. And in this higher for longer scenario, you end up getting something breaking. Wouldn't be great. This would be more of a severe banking crisis, right? Number 5 is deemed to be the worst case scenario. The worst case scenario is stagflation. Not as likely as one may think, but it is a concern. It is likely at least for a few months once the economy starts to weaken. In other words, the economy weakens, but you still have high inflation. Now you're in stagflation. This is a less likely scenario, but it is still possible. Imagine a few months of rising unemployment or sticky, even rising inflation. It will take some time for a weakening labor market to actually bring inflation down. I put a little sad face here. This scenario is the most negative for risk and most positive for the US dollar. Central banks will have to stick with high rates despite a weakening economy. The longer this goes, the higher the risk something breaking and stagflation continuing as something breaks. Haha, typo. Anyway, then you have scenario number 6, which is a central bank blink. Okay, that is a little bit of a tongue twister. Central bank blinking. So the central bank blinking is basically delaying the landing of the economy, which ends up making the recession risks worse in the longer term per Bank of America. This is basically where you cut rates too early because you get spooked by something. And when you cut rates too early and you get spooked, you end up having the Fed temporarily call a victory. That is, they run a victory lap. But then you end up inducing inflation again, and you have to go right back to raising rates, which could lead to a worse hard landing. So these are the 6 scenarios that Bank of America believes are likely catalysts here. Specifically, their concern is that inflation will stay stickier for longer. And by staying stickier for longer, you're increasing the odds of a hard landing, which is their baseline forecast. The Goldilocks scenarios are really that you end up with either a soft landing or a no landing, which is basically the economy just keeps booming. Personally, again, I don't think today's employment report was great. I think, it was much better when we had job gains than losses. Well, we didn't have losses. We still had job gains. But I would have rather us beat on the number of people getting jobs and gotten a lower read on the wage gains. But instead, we got a higher read on the wage gains, a revision up on wage gains for the prior report, and a revision down on prior employment. And then obviously a miss on this employment. To me, that's not fantastic. That's the opposite of what you want. You want softer wage gains, still wage gains though, people can still earn more money, but softer levels with more people having jobs. So personally, I think we got the worst of both scenarios, but we'll see. Some people didn't want a hot jobs report. Anyway, these are the 6 scenarios. Curious to know what you think, so make sure you leave me a comment to let me know which scenario you think that we are in at this time.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by